There is a market crash coming, and it's going to be bloody. In this training, I'm Tom Goolsby. I'm the creator, director. I'm the force behind chartingwealth.com. I'm going to be presenting this training to you, and in this training, you're going to learn a number of things. Three primary ones. You're going to learn how to recognize a market crash. You're going to learn specific ETFs to maximize profits during that market crash. And you're going to learn how to set up a virtual printing press to help you make money time after time, month after month, year after year. I will be the first to tell you that this takes specific knowledge. It takes practice over time. You will not learn this overnight. Anyone who tells you that is a liar and is just taking your money to give you false hope. But it is extremely possible. You do not need any kind of advanced education. You need a brain, and you need perseverance, and you need to pay attention to the rules. The reason we created the rules is through trial and error in the past, and we're going to help you cut through so much of what I've been through and so many others have to learn what it is I've been able to hone. And we're going to go ahead and get down to it. What you are looking at on the screen right now is called a stock chart. What you see in the middle of the screen, and we are using something called freestockcharts.com. You can actually download freestockcharts.com for free. You'll see in the show notes there is a link to the layout that we are using right now at freestockcharts.com. So you can go later, you can go download that, and then you can download, and we have instructions there in the show notes. You don't have to look at them now, but you'll see in the show notes there are instructions on how to download the layout, and you'll have exactly what it is we're showing you now, and we're going to teach you from. So what you see in the middle of the screen, it says SPY. That is a three-letter identifier. In the stock market, there are 3- and 4-letter identifiers that are the symbols for stocks, ETFs. Those are exchange-traded funds. They're like stocks. They trade like stocks. They're not stocks. They're typically baskets of things. They might be, like this is the S&P 500. That stands for Standard & Poor's 500. It's 500 big companies in the market, lots of the volume, international companies, big companies that make up what's called an index, which is just a basket of stocks, basket of companies. Well, ETFs, an exchange-traded fund, is what SPY is, and it's actually called the Spiders. That's an abbreviation for Spiders. It's a company. A Standard & Poor's 500 Trust Series Exchange-Traded Fund. What does it do? It actually tracks the movement of all of these companies, all of them together at the same time. It gives you a broad sweep of what's going on in the market. There's another fund that we track on a daily basis, exchange-traded fund, another index. It's called the Qs. It's the NASDAQ 100. It's all those big tech companies that you hear about in the news all the time. We also track 20-year bonds and gold. We do that on a daily basis at chartingwealth.com for free. Want you to join us there after you get finished with this training on a daily basis. You'll understand more and more and more about what we do. So as we look at this chart, let me quickly show you the things that we have on it and give you a brief description of how we use them. This is ultra simple, but extremely sophisticated and very effective in helping you see what goes on in the stock market and how to track things. Now, I will be the first to tell you, not all stocks or ETFs are trackable. Why? Because they just tend to not move in any good order. But something like the S&P 500 moves with our economy, which can change very quickly, but typically you see it coming and it happens over time. And of course, what we have on the bottom of our screen are two lines. One is blue, one is red. The blue line is the price percent oscillator. What is that? That is what's called a stock indicator. It's set at certain time periods, and it is a mathematical formula that's actually plotted, and it shows the change of price over time based on a mathematical formula. I can go into exactly how that's calculated. You can sit and calculate it yourself, but the beautiful thing is You don't have to do that anymore. It's done for you by freestockcharts.com. And besides the price percent oscillator, we have another oscillator which is in the back of the screen. It's light green and red rectangles, lines that pop up and get bigger and larger, smaller over time. And they change from red to green when certain things happen. Now, I'm going to go back and explain to you what these oscillators do for us in just a minute, but I want to show you the rest of the stuff on the chart. We have dashed blue lines that are called Bollinger Bands. What are those? Well, those are volatility bands. Volatility means price is moving a lot. When these lines get closer together, that means that volatility, that means that price change is reducing, that price is not swinging back and forth as much. When they get further apart, as they do in January of 2019, where we see red lines, big red lines moving down, that is telling us that price is changing a lot and that volatility is swinging a great deal. Then we get to things in the middle of this light blue area on the upper chart, and we see rectangular red things, and we see green boxes also. These are called Heikin-Ashi candlesticks. Candlesticks were developed by Japanese rice traders back many centuries ago to help them figure out what was going on with prices as they traded rice. And they came up with an ingenious system to actually plot where rice prices were and to help them figure out if prices were increasing over time or if they were being fooled by movements in price. And what they developed, a very simple candlestick where they had what's called the opening of the price, the closing of the price at the end of the day, the high price during the middle of sometime during the day, and then the low price. Well, we have sort of a modified candlestick, but I will keep it simple and not get into the Heikin-Ashi candlesticks that we use. But the typical candlestick works this way. When it's a green candlestick, it means price is moving up. The price starts at the bottom of the green candlestick. That's where things opened. And the top of the candlestick is where things closed. When you see a wick on top, it means that somewhere during the day price went up that high and then came back before the end of the day to where the candlestick closed, the top of the candlestick. Red candlesticks are opposite. It means price was going down over that period of time. I'm saying day. What we're actually looking at now is a weekly chart. These candlesticks can represent different time periods. But for the example I was giving you before, price opened at the top at the beginning of the day, and at the close of the day, it ended at the bottom of the candlestick. It's a red candlestick. And then somewhere during the day, the price went all the way down to the bottom of the wick and then ended back up where the candle ends. So again, the beautiful thing about candlesticks is they allow us at a very quick glance to figure out if price is heading down and if it's heading down strongly, or if it's going up and if it's going up strongly, or weakly. And when I say weekly, W-E-A-K-L-Y, weekly. And what's so beautiful about our charts is we can go to a candlestick and we can press down on a button on our screen and it pops up and shows us the price. So we can see that when this candle first opened, if you look over to the left of the screen, you can see it opened at 275.79. That's at the red line there at the very top of the candlestick, and then it ended at the low of 259.85, and then it went as low as, 259.85 was the low for the day. It closed at the last, which was 268.95, somewhere along there. And again, that's the beauty of candlesticks, is you can see what's happening with price throughout the time period. Now, as I was saying, these candlesticks can represent any period of time. They can represent down all the way to a minute, all the way up to a year. And in our charts, we typically use 3 time periods. We use the weekly, which is our biggest chart. We use the 2-day, which is our intermediate chart, and we use the 4-hour or half-day chart for our trigger chart that tells us when to jump into a potential buying opportunity. Now, that's what candlesticks are all about, and they are very helpful to help us see price movement. Now, what helps us understand just how significant that movement is going back to the bottom of the screen, is where we see our blue line, our price percent oscillator, our main indicator, cross over the red line. The red line is simply a signal line. It's a moving average that just moves back and forth as price changes. But when we see the blue price percent oscillator cross over the red, that is a strong signal for us, particularly on our weekly chart, that things are changing. And when you look at the chart and you particularly look up top and see price movement, we can see that starting back in July, things had gone down for 2 time periods, and then starting on Friday, July the 6th, 2018, things started moving up. And we can see that the blue price percent oscillator is over the top of the red signal line. That means prices are moving up. And then all of a sudden, we see the week ending 5 October 2018, we see things flip over. We see the blue line push through the red signal line going down at a fairly fast pace. Well, sure enough, over the course of many, many weeks, because each of these candles represents a week, we saw a huge crash in prices. In fact, prices crashed. They started somewhere around $290.51 for this exchange traded fund per share, and went down to a low, literally to a low price of $242.98. That's about $50 in loss on a $290 stock or ETF. That's a big loss, isn't it, per share? I mean, that is like a quarter of the value, 20% of the value of each share that one might own of this. Would you want to take that kind of loss? Well, you know what? Millions of people did. They took those kinds of losses because they couldn't read a simple stock chart, which we have right in front of you. When you see a crossover on the price percent oscillator crossing over the red signal line going down, it's a warning sign that bad things are happening with the price of this exchange traded fund, or could be stock going down, could be commodity, could be something like gold. We talked about gold earlier. It also has crosses over going down and going up. But back to the S&P 500, because our charts work on virtually anything you want to track, but we'll stick with the S&P 500 for now. And what we see happening is things move down until they bottom out. And then they start moving up. But we don't cross over on our red signal line for a little while. Why is that? In fact, things don't cross over until January. It takes a while to confirm that a bottom's actually been reached. Sometimes you think there might be a bottom, as we saw back in June the 22nd of 2018. For 2 weeks, things went down, but there never was a crossover on our chart. We would have been fooled if we would have sold everything and then things turned right around and popped back up again. That's the reason that we obey rules like crossovers. We call these weekly vertical crossovers, and we signify them with a gold vertical line that we place on our charts. That gold vertical line is very, very important because it signifies a huge change in trends. Now, for the first thing that we wanted to teach you was recognizing a market crash. Well, that is not all that hard to do if you know just the simple information I just shared with you. If we look at a monthly chart, we can go back to, in fact, I'm going to broaden it out just a little bit more. I'm going to go to a quarterly chart. This represents several months of movement, and it can take us back very quickly on just this one chart for many, many decades, in fact. And we can see back in the year 2000 when the market rotated over going down on the quarterly chart. So each one of these candles represents literally 3 months of time. And we can see where things crossed over going down back on the quarter ending the 30th of June 2000. And the market proceeded to go down for years. Years. But there were people who stayed in the market as it was crashing and lost 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 until they probably thought they couldn't lose anymore. And then the market finally bottomed out sometime around the end of the year 2002. Okay? So for a year and a half, things went down. And then it took the market a while to find its feet and start moving back up again. And we crossed back over going up back in 2004. And things shot up from that point all the way until, you guys got to remember this, the end of 2007. Then they started crashing again in the month ending, that was the 31st of March 2008, and went down all the way through 2008 through 2009, and then finally started recovering sometime around the bottom of mid-year 2009. So went down for a year and a half, and then recovered enough to cross back over going up back in the end of the year or the beginning of the year, we'll say 2011, and shot up and have been shooting up. But we got something interesting happening. We've seen some real problems in the market over the last couple of quarters. The past quarter so far looking pretty good as far as some prices go, but we're having some real problems with our indicators telling us that there's some real systemic problems going on. But this overall chart shows you that it's not rocket science to figure out what's going on in the market. It's charting. That's what it's all about. Now, before I leave these charts and get into some other specific information for you, I want to talk about the role of the derivative oscillator. It's that second oscillator. One thing we like to see happen, and the only reason we really use it to help us confirm how strong crossovers are and how long they might go. We have found over time that when the price percent oscillator crosses over going down, if the derivative oscillator crosses over at the same time or near the same time, it typically means that we've got more confirmation of the fact that that crossover is a real thing and is going to keep going. That's about all we really use the derivative oscillator for. Our main indicator is the price percent oscillator. For those of you who are familiar with indicators, the price percent oscillator is a percentage indicator for something called the MACD, or moving average convergence divergence indicator. I'm just saying that for the people who've heard of the MACD before. The price percent oscillator actually is better than the MACD in that it's based on percentages and not just raw price, which allows us to compare it over time, and it adjusts over time. Helps us in some specific and very handy ways. But my friends, that is how easy it is to see market crashes when they start to occur. We're simply looking for crossovers on our larger charts of the price percent oscillator crossing over going down. Now, as I show you the chart that we are looking at now, we can see that it is continuing to go up. The derivative oscillators lost some energy, but the price percent oscillators continuing to move up, reaching higher highs. And that's fine. We'll continue to keep our eye on things, but when we see that start to rotate over going down, that is going to be a signal that we have a down move. Now, it doesn't mean the entire market's going to be crashing like it did in 2008, but That will be the portend for down moves. And of course, what do you do when you know that something is going to go down for weeks, maybe months, maybe years? Well, you don't stay in it, do you, my friends? You get out, you keep your money safe. And that then allows you to buy things back later at a cheaper price. It's called taking profits. If you had gotten into the S&P 500 when it turned around heading up on our charts back in February, beginning of February 2019, somewhere in the neighborhood of the opening at 257, and things have gone up all the way to 294.95, 257 to 294 is a pretty good return over the course of just a few weeks, is it not? Well, if the market turned over and started heading back down to where you jumped in, you don't want to ride it all the way down, do you? No, you don't. But you know there are people by the millions that ride the market down and think they're doing the smart thing? If all they had was the knowledge I just shared with you, to look at a simple chart and see that the market's going down and get out, think of the money they would save. Take their money, put it into cash, let the market move down, and then get back in again when it rotates over going up. Does this not sound totally, and is there anything I'm not showing you here? No, I'm showing you the simple charts that we use on a daily basis. Is this getting you excited? Please, please tell me it's getting you excited that someone's cutting through the bull, the stuff you hear on the news every day, and giving you a simple chart to look at. And folks, we track this for you every day for free. You can listen 10 to 15 minutes a day. You can join us and track these things with us on a daily basis and learn how to do all of this and get good at it. It is not rocket science, it's charting. And you can learn to do this. Or you can simply listen to the news and you can not do anything or hope beyond hope and lose everything. Because I'm telling you, when this latest market rollover, when the next one occurs, it is going to be catastrophic, I believe. There are so many bubbles out there, bubbles in real estate, bubbles in the stock market. When any of the legs get kicked out from under this market, it's going to be a massive sell-off, a massive crash, and it is going to destroy people. So, if that is the case, and things are going to roll over and hammer down, what do you do? Well, one thing that you can do is you can look to other things that might be going up when the market is going down, such as, what about something like gold? How many of you are interested in gold? I hear just like all of us, we hear ads all the time about gold and gold prices. Now's the time to buy gold. Gold's at all-time highs. Gold is going up again. Well, if you look at our chart, my friends, and let me run this chart back for you in time to show you how incredibly accurate our chart is. I'm just going back a couple of years now. But isn't it amazing when you look at our chart and you see it rotate over going up back in January of 2018? It goes up for many weeks, slides sideways a little bit, peaks again, and then about the time that it hits the bottom, it rotates over after it's gone up for many weeks and peaks one more time, but then rolls over hard and down, 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 down for many, many, many months, and then bottoms. And then guess what? In October, it starts to move up again. It moves up for a few weeks, slides sideways, and then takes off up until the last few weeks as I record this for you. At the end of March, gold rotated over again, going down. And when you look at this chart, you can tell that every time gold moves, it moves in the direction of our chart for many weeks. In fact, it's what we call chartable. It is something that you can rely on fairly consistently. Would you want to have purchased gold when our chart rotated over going down back at the end of March 2019? No, you probably wouldn't, because it's lost many, many dollars per share on the ETF. Now, what's interesting about GLD, it is a gold exchange traded fund. It tracks the price of gold, not at gold's price of $1,200 or so, but at a tenth of that, which makes it a lot more affordable per share. But it tracks it, 10% of the price of what gold does. So gold goes up $100, it goes up $10. And again, it's tied to the price of gold, which makes it really cool because you can follow the percentage changes in gold. And what do you think will most likely happen when the stock market crashes? Well, as the stock market's been going up over the last many weeks now, we've seen gold rotate over, and gold doesn't move in line with stocks. In fact, when the market was going up for a while, gold was going up. It has its own way of moving. However, chances are very, very likely, if you think about common sense, if the market's crashing and money is disappearing, fiat currency, the Federal Reserve notes that you use as dollars, as those are disappearing as the market crashes, don't you think something like gold, that has been a store of wealth for thousands of years for human beings, is going to fly up? It may very well do that. And in fact, if it is, we'll know it because we'll follow the stock charts. And guess what we'll do? We'll ride gold up as the market crashes. That's one choice. Another choice that we have are bonds. These are 20-year government treasury bonds. Typically, when the stock market's not doing well, bonds do well. That may very well be another option for us. We also have options when we go back to the S&P 500 of something called inverse funds. What are those? Well, those are funds that move in the opposite direction of the S&P 500. Now, does that seems a little bit counterintuitive? How does something go up when the underlying thing that's represented there goes down? Well, they're called inverse funds. And in fact, the traders that run these funds short the actual fund itself, and that could get me into a number of things. Basically, shorting is when you sell something you or someone else owns to buy it back later at a lower price. And that is exactly what these traders do in things such as, I'm just going to give you an example of one, SH, which is a short fund. Now I want you to watch before I hit and enter the symbol. We can see where the SPY has been going up for many, many, many weeks. When we switch over to SH, we can see that it has been going down for many, many, many weeks. That is because it is an inverse fund to the S&P 500. It has a much lower price. It's not $290, it's $26.76 a share, but it tracks percentage for percentage the change in the S&P 500. The S&P 500 goes down 3% for the day, SH goes up. So that's another option that we have when the market crashes. Now, of course, the first option is not to ride the crash down, to take your money, put it into cash, and just watch things crash, buy everything back cheaper. But the other option you have, if you can read a simple stock chart, is to ride the market down in something that's going up. And again, it's something that's chartable. It's something where we can look at the stock charts. And in fact, when the market went down starting in October of 2018 and went up until the end of the year of 2018, what did we see SH do? It actually shot up. It went from an opening price at the crossover of, let's find that opening, $27.47 to a high of $33.59. That's one heck of a gain percentage-wise, is it not? Well, that's what things are about when you follow inverse funds. So they give you all sorts of opportunities, just like regular funds do when the market's going up. So that's a whole nother way, and those are specific ways that you can maximize profits when the market is crashing and everyone else is hoping against hope things are going to turn around. And of course, when we look back in time and we see you can hope all you want to hope when the market crosses over going down, but it's going to go down and it's going to go down. And when it crosses over going up, it's going to go up and it's going to go up. And when it crosses over going down, it's going to go down. That's what the market does. It goes up and it goes down. Now, it's very, very important for us to pay attention to the market. In fact, at chartingwealth.com, we pay attention to the market every single day. We have rules not only for employing the weekly chart, because we just don't wait for the weekly to cross over and immediately jump in. No, no, no. We have rules where the weekly, for us to jump into a trade, the weekly and the 2-day have to be moving in the same direction. That's the 2-day chart. It tracks things on a 2-day basis. Every candle represents 2 days. So we want to see our weekly and our 2-day moving in the same direction. And then we go to something called the 4-hour or half-day chart, and we use it as a trigger chart. And once our 2-day and our weekly are moving in the same direction, we wait for our trigger chart to give us an actual trigger. That's typically a pullback moving in the opposite direction than, say, an up move. And then once it crosses back over, going in the direction of the 2 larger charts, we jump in and ride that trend. That protects us from pullbacks, from false crossovers, from things that can occur. But as you can see from our weekly chart, we don't have those occur very often. They can occur, but again, we track charts where we are able to follow established trends and trends that go well. Now, the other thing that we want you to be able to do is not just to rely on this crash that's going to come in the future, but over time to be able to use these charts to good effect to actually create your own virtual printing press. That is to be able to jump into movements and trades and be able to make money as the market goes up or down. Down in inverse trades, up in trades where the market is moving in a sustained up direction. Let me show you one of the most recent successful trades that we have had lately. Going to go to the Qs, that's the NASDAQ 100. And when we look at our weekly chart, we can see that our weekly chart crossed over going up all the way back in January the 25th, the week ending then, because it's a weekly chart, so it's always signaled at the last day of the week at the close of the market. That's where our weekly vertical crossover occurred. We've had many, many weeks of up movement. And over that course of time, we've entered into and out of the market at certain periods. But things have been set up for consistent up moves for us. And we go to the 2-day chart and look at things. And the 2-day chart's been going up, up, up for many months. It's just now starting to weaken on us. And then the last trade that we did, just to give you some idea, so like I said, the 2-day and the weekly are moving in the same direction. Well, the last trading opportunity that we had was after a pullback, and we had our last crossover going up, the last super strong one, on the first day of April. We had a crossover going up in the morning, because again, 4-hour charts basically represent a morning candle and an afternoon candle. We had a crossover going up after what we call a pullback in the opposite direction. And when the chart crossed over going up and closed, we had a jumping in opportunity that afternoon somewhere around the 180, we'll say 181 mark. And we were able to actually ride this up for many, many days, from around 181 to somewhere where things started getting weak, right around the 191 mark. So literally $10 we made per share on the Qs trade, a very simple trade based upon the weekly and the 2-day moving in the same direction. waiting for a pullback on the 4-hour chart and then a crossover going up and a jumping in point. In fact, we talked about this day after day after day after day after day at chartingwealth.com, and all of our students were following that with us and practice trading these things. Now, when I say practice trade, that is what you're going to need to do for quite a while so that you're able to understand what it is we do here. Practice, because if you start trying to start doing any of this with real money first, we're not a stock calling service, we're an education firm. We want you to practice with us until you actually learn how to do all these things with practice trades and get very, very good and experienced at it. It's going to take you some time, energy, effort, but every minute you put into this can yield you thousands and thousands of dollars or more once you learn how to read these stock charts. Just imagine having the ability, month in, month out, to be able to see opportunities, invest, buy, let it go up, sell it, take a profit, and put that to the side. That is literally a printing press that you can use month after month, year after year, to add to your wealth, to give you early retirement choice, to let you pay for a better lifestyle, to let you do any number of things. And imagine the opportunities you have with self-directed 401ks, IRAs, all the things that you can do where your profits are tax deferred. I mean, imagine those kinds of opportunities. So that's what we explore. That's what we train for. That's what this is all about. And it is not rocket science, but I'm the first to tell you that it does take practice. It takes patience. But the rewards are phenomenal. Because, my friends, when this next crash occurs, I've been through 2 of them. I have seen the results. The first, I got screwed back in the dot-com bubble. Back that first one I showed you back in 2000. I was a younger attorney at that time practicing law. I'm going to go to my quarterly chart and we're going to go back to that. I was a young attorney practicing law. I'm sorry, yeah, it was right there at 2000. And I had been making good money for the last few years. Hadn't been practicing law long, but I had had some good years. And I had socked away about $100,000. And during the dot-com, the bubble as it was building up, I had my money in super aggressive stuff because I was young, okay? I'd started going into the law practice around the year, it was like around 90, 91, 92, really got into private practice around 93. And I had socked the money away and I had ridden this bubble up. I had started at the beginning and the bubble had gone up and my $100,000 had gone up to $300,000. Now, I am busting my ass, young in my career, working 60, 80 hours a week. I didn't have time to manage my money, nor did I even know how to do it. I did have an MBA, I did have a law degree, I did have an undergraduate degree in business, but you know what it did for me? Nothing. So those of you out there who think, well, I only have a high school diploma. I got an associate's degree. I have a graduate degree in education. Well, that's good. You don't have to have any of this experience. I had all sorts of stuff. It did zero for me. I mean, zero. So what ended up happening is I was at 300,000 when the market rotated over going down, we'll say September of 2000. And all of a sudden I get my first report as the market starts crashing. We'll say December of 2000 and then on into March of 2001. And I mean, it just kept every month or so I would get a report. And it would be like, you lost $30,000 this month. You lost $40,000 the next month. You lost another $30,000. You lost $38,000. You lost $20,000. It went down, 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 down. I kept calling my broker saying, hey man, what are we doing? Why am I losing all this money? Well, you know, we rode this bubble up. He didn't use the word bubble. I later know we rode the bubble up. The bubble had popped. But I was never told to get out. I was told, hey, we hope it's going to turn around when it does. We want to be there to capture the up movement. Well, guess what? My 300, my 100 that moved up to 300 crashed all the way down until it got down to $95,000, from 300 to 3 to 5,000 less than what I started with, because I couldn't read a damn stock chart. Now, you want to talk about being mad and angry? Imagine what could have happened, okay? And this is what I want for you. This is what I want for us. Imagine what could have happened to this young lawyer, me, when the market rotated over going down, if I would have seen it. And I said, okay, the market's rotated over going down. Maybe I even waited a little late. Maybe I lost a few thousand. Maybe I lost $10,000. Maybe I didn't get out until I'd lost down to 290 or 280, whatever. And then I got out, put my money in cash, or even better, in an inverse fund. We'll just say cash or gold or whatever, but just cash, nothing. I just get out of the market and let it crash. And then instead of starting off over again sometime in March of 2003 with $97,000, imagine if I'd started off in March of 2003 with not $97,000, but with $300,000 or $270,000, and then ridden that back up before the next crash came. Can you imagine? My roughly 300, what if it went up 3 times like it had before? It went up to 900,000, okay? And then the market crashed, and then I jumped back in with my 900,000 and rode it up to 3 million. Do you see what I'm talking about? Do you see how critically important this is? This is so important that it is literally life-changing, life-saving. Your life savings can be at risk. And we're talking about simple things that you can do, but you've got to do it on a daily basis. Now, for those of you who are interested in truly understanding what it is that we do and doing so much more than just these simple things, but getting involved in a whole new way of investing, of charting, of understanding, we have a step-by-step course that we are offering. It is our secrets on how to trade and how to invest using our trend following techniques, the things I've just taught you, but so much more in depth. Now, this is a course. It's going to cost you a few dollars, but it's going to help you set up a complete marketing platform using the stock market indices, using sector funds, using stocks and commodities you might be interested in to track, to trade, and to invest. You're going to learn how to use the oscillators I just showed you, plus a little extra, plus a volume indicator that's going to help us track and make expert timing decisions. You're going to set up a funded trading account once you get really good at this. And as your success mounts, you're going to move trading profits to your investment printing press, where you're going to use options, things like covered calls, call options, and puts to amplify your wise market moves. You're going to learn to use these options to magnify trading gains. You're going to learn how to set triggers for buying and selling and locking in these profits. Our goal is to maximize profit using our simple yet effective techniques honed over years of training and experimenting and learning. Dumb mistakes are going to cost you so much more than this course ever could. We're going to give you the hacks. We're going to put you on a course, a level that you can't imagine. You're going to learn techniques in a few minutes that would take you decades to figure out, if you could afford the losses over time. Now, why should you start now? Well, I cannot tell you when and if we're going to offer this course. Again, I've never offered it. Those of you who've been with me for years at chartingwealth.com, you know we've not offered any courses like this before. I've hesitated for years to share all this information, but I'm telling you, my friends, I'm convinced that in the next 12 to 24 months at the outside, 24 months, it could happen anytime, but we're going to have a systemic market crash unlike anything you have ever seen. And those who are not prepared will lose everything. And I'm not alone. Wall Street veterans, well-known investors, I mean, they are scores of them. You can listen to Peter Schiff anytime, Max Kaiser, even George Soros' former partner Jim Rogers, who I have followed for years. I heard him interviewed recently, and he is convinced that we're already in the danger zone as we look like places like Venezuela, the property being locked up in places like Australia, the problems in Turkey, all the things that are going on. We are already in the danger zone. So being forewarned is being forearmed. You've got to prepare now. You honestly do, my friends. You've got to prepare now. You can do this. You must do this. You guys know me, those who followed me for years. You've seen the channel, and many of you have followed my daily and weekly market reviews for years. There are a limited number of slots available, and once the training is full, we're done. There's no more entry, period. If you put off the training, I can assure you you're going to regret it. And I can't tell you when and if we're going to do it again. So just do it. Invest in yourself. Invest in your future. The cost of the training is minuscule, minuscule compared to the potential knowledge we're going to give you. You'll never look at investing the same again. And I can't wait to welcome you to the class. I can't wait to send you our outline and to start sharing the knowledge with you that will radically and positively affect your life and the lives of your loved ones. So hop on board. The train is at the station. It is filling with passengers, and we will be leaving soon. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.